Hello, I'm Grace. Warning lights are flashing in the financial markets as the scale of Bit2, a Korean term for investing through borrowed funds, has reached a critical threshold. According to reported figures, the current scale of credit loans and debt-driven investments by domestic investors is approaching approximately 75 trillion Korean won, approximately 54 billion USD. This level of debt has moved beyond mere individual investment preference and has reached a significant volume that could threaten the overall soundness of the national economy. The Bank of Korea, BOK, the nation's central bank, has issued a stern warning, judging that such excessive leverage is weakening the market's fundamental strength. The most immediate concern is the potential for massive losses faced by individual investors when a stock market correction occurs. As stock prices begin to fall, the value of collateral declines, triggering forced liquidations, which in turn creates a vicious cycle leading to further market crashes. The market volatility arising from this process goes beyond a simple reduction in individual wealth, amplifying uncertainty across the entire financial market. Compared to past precedents, debt-based investment acts as a double-edged sword. It maximizes returns during bull markets but exponentially magnifies losses during downturns. The current situation is particularly concerning as it coincides with instability in the real estate market, further deepening the vulnerability of the overall financial system. With rising housing prices, household debt, and debt-driven stock investments becoming intertwined, downward pressure on the economy is acting from multiple angles. Furthermore, the foundations of the real economy are being shaken by continued poor performance in the construction, real estate, and wholesale and retail sectors. The sluggishness in these industries poses a significant risk of spreading beyond specific sectors to deteriorate the financial health of banking institutions. If interest rates remain higher than expected or continue to rise, we may also see reversal phenomena in specialized financial products, such as repo funds. Ultimately, we cannot rule out the possibility of a structural risk materializing, where individual debt issues evolve into a liquidity crisis for financial institutions. In conclusion, the current financial market stands at a very dangerous inflection point, where the quantitative expansion of debt clashes with the qualitative stagnation of the real economy. At this juncture, sophisticated risk management and decisive policy responses are urgently needed to manage market volatility and prevent a systemic collapse of the financial system. I'm Grace, thanks for watching.